Hi, my name is Gravelle. This is Dr. Cresson's 452 investment analysis project. The basis of this investment analysis, the strategy used is that it's very hard to beat the market, so why not let the market work for you? The way I did this, there's an index fund, and it's called a SPDR. It has the stock ticker SPY, and basically what this is an index fund that tracks the S&P 500. Because the strategy is you're not going to beat the S&P 500, or it's going to be very hard to beat the S&P 500. And a lot of these mutual funds that try to beat it fail. Or additionally, they have extra expenses that takes away from their overall return and gives you a lower return, making these SPDRs more beneficial to the average investor or the lazy investor. And what I did was I took the SPDR, the S&P 500, and 5 random mutual funds, and I picked these mutual funds at random, but all but one was rated 4 stars or higher by the Morningstar investor. One was rated 3-star, so these are actually pretty good mutual funds to compare to. They're not terrible mutual funds, and they're mutual funds that a lot of people have a lot of different money in. So first, to make this an index fund for the S&P 500, I did a correlation matrix just to confirm that it is indeed correlated with the S&P 500. So as you can see here, the S&P 500 is correlated almost 100% with the S&P 500. It's 0.981, so it's not exactly the S&P 500, but it's very, very, very close. The next one that's closest to the S&P 500 is TESIX, and that's 91, which is about 10% off the S&P 500. So what I did to compare it, in addition to the returns, they also had, other than the S&P 500 itself, they also had different expense ratios. These are the returns that I've gotten over a 5-year period, the last 5 years. And I basically found the risk, which is the variance of the stock, how much it deviates from the mean. The average monthly return, I found the average of the monthly return over the last 5 years. And also a key factor is the average monthly expense. As you can see, the SPDR has a much lower average monthly expense. It's about 0.1%. The next lowest is about 0.5%. With the highest being 1.5%. So it's the expense ratio to keep track of this and to manage this is a lot lower than the other ones, and that has a huge impact later on. So as we can see, the risk of this compared to the S&P 500 is a little bit higher, again because it's not 100% correlated with it, and the return on the S&P 500 is a little bit higher, again it's not 100% correlated. But if you compare it to the 5 mutual funds, it has one of the lowest risks. There's only 2 that have a lower risk other than these SPDRs. One is almost exactly with the SPDR, so it's almost pretty negligible, except it has a yearly return of almost half that of the SPDR. The other one had a risk that was much lower. It was 21% less risky. But in exchange for that, you have a 44% decrease in return. So again, you're getting a little bit less risky, but for a greater cost of return. So if you take it and you take out expense, the return, they had 2 of these that had a greater return. One was the actual S&P 500. The only other one that had a greater return was this one right here. Now it had a greater return, but it also had a much greater monthly expense. So after you take out the monthly return on expenses, it actually still ends up having a lower return than these SPDRs. So even after it has a greater return, you're paying a lot more to manage these mutual funds, and in the end, it still gives you a lower return. So again, if we look, the yearly return, it has the highest return, one of the lower risks. The only thing that beat it outright was the actual S&P 500, but again, that's why the point of these is to correlate with the S&P 500 to get these higher returns, lower risk. So basically proving that, you know, in the end, you really can't beat the market, or it's very hard to beat the market. A lot of people try, but in the end, I feel if you invest in an index fund with these SPYs that correlate to the S&P 500, you're going to get lower risk and higher returns, or you're going to get the same risk with high returns, or greater returns with the same risk. So this, in the end, this strategy, it did work out with these 5 mutual funds, and I feel like it can work in real life too. Thank you.